Welcome to Next in Tech, an S&P Global Market Intelligence podcast where the world of emerging tech lives. I'm your host, Eric Hanselman, Chief Analyst for the 451 Research arm of S&P Global Market Intelligence. And today, we're going to be looking at the security mergers and acquisitions market, something that's been really active of late. And we're bringing back returning guests, Garrett, Bekker, and Brenon Daly. Gentlemen, welcome back to the podcast.
It's great to be back. I guess you must have run out of other analysts to join you, so happy to come back and talk it up with you.
Oh no, you're straight in our crosshairs with everything that's been going on,
For sure.
Especially where we are coming up to the RSA Conference. We've got some perspectives that are happening there. Garrett, of course, right in the middle of all of this as well.
Yeah. Good morning. Thanks for having me back. And I get to skip out on RSA this year, so I'm lucky.
Well, it's clearly there's a lot going on, and there has been a lot going on leading up to this. And I want to start with what clearly is the M&A topic on everyone's mind that has a really significant security component to it, which is the Broadcom VMware deal. So if we think about significant transactions, this certainly is one that kicks things off with a real bang.
Yeah, and it's very much of the moment. And so obviously, just printed yesterday as we record this, third largest tech transaction in history, obviously the largest software transaction. And just to think about this, a seminal moment for what had been a virtually unknown company in Broadcom, right? Obviously, Broadcom is a little bit of a chip consolidation play. Had rolled up at a number, almost I think 10 different chip companies along the way. Still not a very certainly not a very well-known company in outside of sort of networking semiconductors. And yet here it is 4 years ago, right? We're just 4 years into this massive build out. I mean, it is unbelievable when you think about from a standing start, they now have a $20 billion software portfolio. So think about that. Just to put that in context, right? That's basically the same size as IBM's software portfolio. And so, IBM's been at it a little bit longer, call it 20 years, 20 or 30
well,
years.
As you say, I mean, if you look at the pace, that's pretty impressive.
Yeah, and so it's the scale and the size. And remember, this is done in 3 transactions, right? You're talking about basically $90 billion of spend, 60 for VMware, 20 for CA, 10 for Semantic, right? So there's no other company on the planet that is doing these kind of sort of plate tectonic transactions. And so now they've got, a software portfolio that if we run it if we screen it, what's happening, versus other software providers, it is by CapIQ's estimation, the 5th largest software provider on the planet. Broadcom. And again, this is not even a half a decade old initiative, which just shows how much the market has swung, how much software has matured and just become part of the infrastructure, right? That's all this is it's basically almost a private equity style consolidation around a very specific vertical in infrastructure software, where you have all of the attributes that private equity would look for, in this case, in a publicly traded company. So just to put some points on that, cash flow is king for Broadcom. When they acquire companies, they tend to focus on the top tier customers and sort of let the others roll off as they will. You saw that in how they sold this deal to the street yesterday. They were talking about almost doubling VMware's cash flow. You're talking about from basically $4.5 billion of free cash flow, which is it's a lot of money to play with. They're talking about taking it up to $8.5 billion in the next few years. So
this is sounding very private equity-like in terms of their expectations about where they're going to take this. Yeah,
exactly.
Yeah. It sounds similar to Semantic, though, right, Brenon? Like everything I've heard, it's not just been about cost cutting, traditional cost cutting, but it's also been about rationalizing customers, right? Like from everything I've heard, Symantec, focused on their top 20% of their customer base and basically just let everyone else wither away.
Yeah, and financially it makes sense if you're cost conscious, because you think about the debt that's associated with this. Obviously, rising interest rates make the threshold for return a little bit higher, and you have to service that debt. And the way to service that debt is increase cash flow, and that's certainly the plan of attack in Broadcom. And man, they certainly have the precedence, right? They have that standing and they have that reputation as a highly efficient operator. And so, it does open the question, Garrett, as we were kicking around before we started recording here, what happens when those two portfolios, when the portfolio from incoming VMware sort of overlaps, because there is some overlap with the assets they already have inside of their sort of infrastructure bucket.
Yeah, no, for sure. And that's something we were kicking around yesterday. Our esteemed colleague, John Abbott, wrote up a report on the transaction yesterday. And one of the things we were trying to figure out was, where are the synergies? The question is, how much is this deal about operating synergies? I know we've written and we've talked about this before with Broadcom when they bought Semantic, right? Was it really about operating synergies, or is it as much about financial engineering and how, Broadcom is arguably operating like a private equity firm these days as much as they are a strategic acquirer. It's interesting. I jokingly said to my colleagues yesterday that maybe they're looking to use VMware to provide a virtualized operating layer for aging software companies. But one of the areas that they were really going to, I guess, look at is you mentioned before we got on was what was around the endpoint. Obviously, Symantec, one of the things they were known for was their endpoint security portfolio and their big presence there, and some of the things they had acquired and developed over the years. Obviously, VMware acquiring Carbon Black, was it last year or the year before, was a big one. So it's going to be interesting to see how they look to combine those two assets. Mm-hmm. My main area is around identity and access management, as you may know, or just for the sake of our listeners. From what I gather, I don't see there's a ton of overlap there. As far as I can understand, CA and Symantec basically rationalized their identity portfolio under Symantec's brand. And VMware did have a product a couple years ago called VMware Identity Manager that I think is essentially fallen by the wayside. So those are two initial areas I'm looking at. I don't know if there was a fair amount of overlaps anywhere else. I don't know. Maybe you're aware of that yourself.
No, those would be the main ones, and obviously the networking side for what Symantec had versus as Eric well knows, certainly VMware has a bustling portfolio around some of the networking technology to the extent it extends into security. Again, an area that they'll probably take a real hard look at.
Well, it's an area where, while there's not an overlap, there is a lot of functional synergy, but that's presumably part of where they expect to do some level of integration, although it's not something that they've looked at a lot in terms of what they were expecting from the Semantic pieces for the last go-round.
Quick thought, Eric, and tell me if I'm way off base here, but I'm just seeing potential synergies with VMware on the NSX side and maybe on the segmentation, as Symantec had invested a fair amount in zero trust and cloud security and sort of CASB, SASE type stuff. I wonder if that's maybe an area of synergy.
Yeah, definitely an angle. It's not something that VMware has got a lot of depth in. I mean, they've been looking to build what is a broader SASE story, with the integration of the fellow cloud pieces and sort of trying to add some of the access environment to that. And maybe their integration plays there. My guess is, though, that the VMware technology is a bit more up to date in terms of its general approach. I mean, whether or not that's actually got the network back end to be able to support it is a larger question. But certainly potential there.
Yeah, I don't think that we need to knock ourselves out too much on the integration, because Broadcom tends not to deeply integrate. They focus on maintaining their existing customer base. Yes, upsells are great because they're high margin, and again, pushes through a lot more cash flow. But this isn't a massive engineering project that goes for the next 3 years where you're building one monolithic offering. This is mostly just servicing existing customers and expanding what you're selling them, not necessarily bundling it all up.
Yeah, hey, integration costs money, and that's going to impact cash flow. So, yeah,
and it takes time.
It does indeed, and I guess I want to maybe look at the angle of what this does in terms of speaking to the broader security market. I mean, if we think about how this is transforming a lot of expectations about what deal making is going to look like as we go through, clearly. There's a lot of frothiness around our RSA every year, always. This year, with the shift, moving RSA back to June, we've gotten ourselves kind of into the middle of the year and maybe the beginning of sort of that summer doldrum period. But there's also a lot of market impact that's going to be driving what could potentially happen in this environment as well.
It does. And if we think about, sort of where we are right now in the tech M&A market and specifically in the information security market, if we all agree that the VMware acquisition was basically a private equity, came directly from the private equity playbook, cost conscious, cash flow focused, synergies delivered. If we think about it in terms of a financial transaction as opposed to a strategic transaction, it fits very well with the prevailing trend in the information security market right now. 2 of the 3 largest transactions announced in the information security M&A market have sponsors behind them, right? So we're talking about the take private of SailPoint and the secondary for Barracuda. There's about $10 billion of spend right there. So these big transactions, right? Whereas in 2021, if we think about the sort of go-go year of 2021, financial acquirers were very much secondary to big bets placed by strategic acquirers. And here, I would point to Okta splashing $6.5 billion for Auth0. That was very much a vintage 2021 transaction. And, to be honest, we haven't seen Okta in the market since then. Right? A similar sort of story on a smaller scale for Rapid7 did its largest transaction in history last year, 300 and change for a threat intel vendor, and yet hasn't followed that up with anything here in 2021. So there's been a bit of a shift. Palo Alto Networks as well. Nothing here in 2021. Microsoft did 2, maybe 3 information security transactions in 2021. Nothing so far in 2022. So as the strategic or corporate acquirers and those sort of, the names we immediately associate with the buyers in the information security market, for the most part, they have stepped out of the market, driven out by, obviously, the downturn in the bear market that we've had on Wall Street. And so as they step out, in come the private equity acquirers. And again, they have had a disproportionately large impact in the market here, as we might expect, as we shift from a growth market to more of a value orientation. At least that would be my sort of, as we get set to kick off RSA, that's sort of the way I'm thinking about the M&A market.
Yeah, so very interesting, Brenon. So, a couple of points. One, PE has been a growing influence in M&A and security for the last 10 or so years. In fact, if you look, I've been tracking this for, going back over 10 years now. If you go back to say 2010, private equity was like 3% of all cybersecurity M&A deals. That actually hit its peak in 2021, up just shy of 40%. And in fact, just to play a little bit of devil's advocate, strategics were a big factor last year, but the 2 biggest deals all time last year were Thoma Bravo taking out Proofpoint for $12.3 billion. And then we also had the consortium of Canada Pension Plan and Permira and a whole bunch of others taking out McAfee for $12 billion. But to your point, and this is something I've really been paying attention to because I put out a spotlight report about a month ago on security M&A so far this year and last year. Year to date, at least if we look in terms of transaction volume, and in other words, a number of deals, security M&A deals are actually up year over year by about 20%. However, the percentage of deals driven by private equity have really fallen off a cliff. They've gone from, as I said, just under 40% to now around 20%. And yeah, you had the Barracuda deal you mentioned, but certainly that's something I'm keeping an eye on, because if that drops, then the question becomes who's going to step up to take the slack. And to your point, the absence of the Palo Altos and the Microsofts, another huge acquirer in security last year and the last few years, believe it or not, has been Help Systems, which is technically private equity backed, but it's certainly a strategic acquirer. And I just before this call, I did a quick scan of year-to-date security M&A transactions. And one of the things jumped out at me was I think 51 of the 89 deals year-to-date have been from non-traditional security acquirers. And quite honestly, there are a lot of smallish little companies that I've never even heard of.
So do these wind up being sort of tuck-in transactions? Is I guess the thing I'm heading towards is, are we looking at a significant change to the market and some of those dynamics?
Well, certainly, the overriding question every year at RSA is, how are so many vendors still here, right? When we think about the
well, I mean that let's take a quick step back at some of our background data, which is that what's the one place where budgets are increasing? Information security.
Right.
And that's a lot of fuel to keep this panoply of vendors alive. And maybe that's the thing that's that's keeping this whole thing moving. But I think I have a feel for where you're going with that. And somebody's got the hand on the edge of the rug. Yeah.
It's just a simple. I mean, I'm a markets guy. Like I am. That's the way I think about the world. Unapologetic in that, by the way. But if I just look at a markets guy, Garrett referenced earlier, banner year in terms of M&A volume, right? So forget about who's doing the deals, but just the sheer number, right? So we're going to have about probably 250 information security acquisitions here in 2022, 250, right? That's on a base of 5,000 across all of technology and telco. And again, these are global numbers, so it's a comprehensive measure of activity, right? So it's a very, very small percentage. Now, yes, there are outsized valuations ascribed in information security, always have been, probably always will be, exactly because of what you referenced, Eric, around budgets, right? When our own research here from 451 Research suggests that, 90% of IT folks tell us they have more money to spend in 2022 than they did in 2021. Yeah, that's going to draw a lot of participants. But what's happened is it's drawn too many participants. So again, from a market perspective, think about it this way. Think about the overpopulation around, so call it 200, 250 acquisitions each year against inventory in terms of suppliers to the information security market, right? Probably topping 4,000. I think Garrett and I could probably put our heads together and certainly easily come up with 2,500, right? So we're talking about a huge imbalance between the supply, again, from a market's perspective, the supply, in other words, the number of vendors and the number of acquirers. And so ultimately, and that can last because, you have, as long as you have outside funding, you can get away with that. You can exist indefinitely with outside capital. Capital is oxygen. If you can get it from outside, you can stay alive. But we all know venture capital is coming under pressure. You've got Sequoia, you've got Y Combinator, you've got all of these venture firms sounding the alarm saying, hey, winter's coming. Tighten down. Don't spend out egregiously like you have been. So venture capital is going to get a lot harder to come by, which is going to accelerate this rationalization. This imbalance is going to be less imbalanced, again, as this venture capital will no longer support unviable businesses. And there are, in the host of 4,000 information security startups, there's a few that probably won't make it, I'm going to go ahead and say.
Yeah, you hit the nail on the head. And I've been, this topic has come up over the last probably 4 or 5 years. We've talked about it, right? The one thing, I think you totally hit the nail on the head. The one thing that I've been most concerned about and keeping an eye on is the VC funding, right? Because it's contributing to in a number of things. One, it's that overbalance or that oversupply of vendors, right? It's also driving the crazy valuations when you see, companies like Laceworks knocking down a 1.3 billion D round or a, 543 million Series A from Transmit Security, right? I mean, I'm old enough, I guess we all are to remember, I got my start in this business, as you guys know. I started as a sell-side equity analyst in the early 2000s, and I literally got my first job in 2000. So I basically arrived, I missed most of the party and arrived for the hangover. And I barely had my feet wet before the dot-com bubble burst. And I remember distinctly back then how like companies went from overnight to, hey, we need more eyeballs to, what do you mean eyeballs? We need profitability, son. And it was really cruel to watch. And to your point, I just talked to two companies. I know this is anecdotal, but just in the last couple of days, one who just completed a round, and another who's trying to raise a round, and both told me like just in the last month, things have changed dramatically. So, definitely something I'm keeping an eye on, but, yeah, that and also the private equity stuff. I think if the private equity, as a driver of security M&A keeps trending downward, I think that's definitely going to have an impact too.
Yeah, and Garrett, let me just throw one other fact, Eric, and you'll appreciate this as we get ready to welcome RSA out here, obviously in startup land. So I went back I think we can all agree. Pretty tough time on Wall Street for information security companies, whether it's SentinelOne, Okta, Zscaler, right? All of those are down 60, 70, 80%. There's been a bear market, inarguably, for information security companies on Wall Street. So that's the public market. I went into CapIQ and ran how many information security startups have raised billion-dollar valuation funding here in this bear market so far year to date, right? And there's more than a dozen information security companies that in the midst of this almost historic downturn, right, they're able to become unicorns. So, you're talking about obviously, and this includes, just to be clear, this includes, existing unicorns like Garrett mentioned, Lacework, Big ID, Axionis, right, already had their horn, but, got a step up valuation, as well as sort of the new entrants like Abnormal and Material Security, right? So again, this suggests a huge disconnect between value creation and value realization. Just to put a point on that, if you go back and think about, okay, you're creating all these companies, information security companies, venture capital is creating all of these information security companies valued at north of $1 billion. How many have actually exited? And the answer is there hasn't been a single one since the last RSA show. You have to go back all the way to March, right? Auth0 was the last venture-backed information security company to exit for more than $1 billion. Now, they did it handsomely, $6.5 billion, but there's been nothing since then. And meanwhile, we just continue to pile up. Again, this supply and demand imbalance in the market. It's true virtually for any pocket of technology, but it's just doubly true for information security.
Well, as you said, I mean, maybe we should be thinking that winter is coming. Stay close to your dragons, right?
Yeah. So here's a little bit of the devil's advocate side to that, though. There's some reason for optimism. I've always looked back at security as being sort of a port in a storm and sort of a non-discretionary spend, and when times go bad. And again, I go back to when I was starting back in 2000, going through the dot-com burst, and then I remember living through the 07, 08, 09, Great Recession. I think, if you look at the public markets also in M&A volumes, in fact, if you look at our M&A knowledge base, we kind of flattened out. We had a little bit of a downturn, like if you look 07, 08, but it wasn't as terrible as maybe some other sectors. And I think there's some arguments to be made, or there's some drivers in place that maybe can help this down cycle, fare better than the others. And, one of them is, we're in the midst of this cloud migration, digital transformation thing that I think is certainly fueling demand for security. And as Eric knows, one of the things that keeps security going, and one of the reasons why we arguably have 4,000 vendors. As my former esteemed colleague Adrian used to say, it's a market of missing features, right? And as innovation comes along, it tends to open up new security problems that need to be solved. And that's so there's this constant replenishing of the universe, right? We've also had this, transition to work from home and work from anywhere, and I think that's still in place. We've also had a huge change. If you look compared to 20 years ago, security back then was still a little bit of a grudge spend. It hadn't caught on at the board level. It was still one of those things where, hey, if we can avoid this, we will. And, now if you look in the past 20 years, we've had PCI and Sarbanes-Oxley and HIPAA and more recently GDPR and CCPA in California. We've got new NIST guidelines, the executive order from Biden. So I think clearly this is security that is more of a non-discretionary item that certainly got the attention of the board more so than it did back 12 years ago or 20 years ago.
Yeah, certainly. And the results, if you think about, again, coming into RSA here, if you just look at the stock performance and the huge disconnect between the underlying financial performance of some of these companies. SentinelOne, 3/4 of its value has been evaporated, right? And it's still growing at 120%, right? So it is more than doubling revenue. There has been no slowdown associated with that. Zscaler last night reported 60% growth, right? And how has Wall Street treated it as it's actually accelerated growth? Well, it's lopped 2/3 of its value. So there's this huge disconnect, right? Palo Alto Networks is growing faster coming out of the recession than it was coming in, substantially faster. It's almost a 30% grower, right? Okta, you just go down the list. Okta is, growing. It's twice the size of SailPoint, growing twice as fast, and yet it's valued at a lower price to sales multiple than SailPoint. It just doesn't make sense. And so, to your point, I think that overreaction, and Garrett's offering a ray of hope and that's his role. My role is to bring the dour perspective. But I have to also acknowledge that, Garrett is right. Like this is not like these budget dollars are not going away. And we see that actually, $20 billion of M&A spend, just back to my world, M&A spend, right? That's through the first 5 months of the year. That's higher than virtually any other year except last year. So yes, we're going to have a little bit of a step down overall here in 2022, but like I don't want to mischaracterize it. Like it is still, a booming market here for M&A. It's not going to be as booming as it was last year, but hey, that's true for everywhere. but it is still, again, we're already at the second highest annual spend in terms of M&A, and we've still got, the majority of the year to go.
Yeah. Hey, Brenon, question for you. Because as I mentioned earlier, year to date, if you just look at deal volume for cybersecurity, we're up about 20% year over year over last year, which was a blowout year. So far it looks pretty good. The question is, are we headed for that Wile E. Coyote moment where, Wile E. Coyote's run off the cliff and he doesn't realize it until he looks down and then he drops like a rock? Yeah. Do we have to worry about what's coming 2 or 3 quarters down the road? And what's sort of the canary in the coal mine? Like I remember, again, when I was starting out on Wall Street, when we knew things were bad was when we realized all the hardware vendors and software vendors, what percentage of their customers were .com companies that were about to go bankrupt. Is there anything like that you can think of this time around?
Well, I was back since we're looking back on our fabled careers. I was one of those companies that helped prop up that bubble. My company went public in January of 1990. I was a paper millionaire for a little bit there. Had one of the highest performing stocks on pop at the open. Right, we were talking about a 500% gain on paper. Day of the offering.
Not too shabby.
Yeah. Of course, I'm still working, so obviously I didn't get the message. So I didn't have the foresight that Garrett had in seeing like, hey, the party's going to end, and so I guess and that's hence my cynicism a little bit. But to your point, Garrett, like I think there's been a little bit of a shift in the market. So yes, I mean, if you look at who's doing the deals, okay, like Help Systems, yes, they're a corporate acquirer, but they're a private equity play, right? They've done a dozen deals in the last 2 years. They're the single busiest buyer. We've also seen, think about like heavily funded information security companies that know they're going to make it. It's turning around and buying those sort of maybe bits of technology, almost like a R&D play, like Devo, for example, out of Boston, right? That log management. They did their first transaction in history last month, right? So we're starting to see, and again, this is just opportunism. So I think if we split number of transactions versus the spending attached to them. Okay, so number of transactions, I think we're safely gonna shatter the record. I think there's virtually no doubt that that we will have more transactions than any year in history. It'll be about twice where we were 5 years ago, about triple the number a decade ago. So that record, pretty much bank on that. Again, because you've got new entrants, these heavily funded venture companies saying like, hey, it's shopping time. Like if we know we have a path to profitability, that fabled sort of path to profitability that everybody wants to see and suddenly really wants to see in a downturn. Hey, you're not going to keep burning, 50 million a quarter indefinitely, right? Okay, if you're not going to do that, then you've earned the right to go take advantage of this opportunity in the market. And that's what it is. It is an opportunity. So I think you're going to see venture-backed companies and you're going to see private equity-backed companies just get out the broom and start sweeping.
I think, again, to some extent, it comes back to VC. And right now, at least what I've seen, the VC still seems to be flowing. I mean, if you look at what about a week ago, YL Ventures just raised another $400 million fund focused strictly on security. So, I think to some extent, as long as you keep seeing that going, that's going to keep propping this industry up.
Yeah, I mean, and you think about just on YL. I mean, I think his first fund, Yoav's first fund, was 60 million, maybe.
Yeah, nice work if you can get it. I guess the reward for being successful, right?
Right, but again, like it just imagine, from the capital deployment perspective, right? 60 million, you can do it in a dozen checks, probably. 400. Yeah. I mean, you're talking about minimum 30, 35 checks that you have to write. So,
right, particularly if you're early stage, right?
Yeah, exactly.
You're not writing late round checks.
And add to that, you're having these dedicated infosec or cybersecurity venture funds, right? That their whole mandate is to basically fund in this sector. And they're all in the sort of hundreds of millions of dollars of funds. And obviously, there's some initial and then there's some follow-on capital, but that's a big pool. And, where I think the change is happening though, and this is an important one, again, is that it's in that late stage. It isn't so much in the early stage, but it's in that late stage, particularly those crossover investors that were sort of positioning their portfolio. These are the Tigers and the GVs and the M1s and that sort of cohort who looked to get sort of a position in a company before it went public. And the way to do that was to get on the cap table in a sort of a growth round. Great. But now you think, that sort of investment strategy has been undone by this bear market that we're seeing. Because what looked like easy money with this step up valuation in an IPO, suddenly an IPO is a down round. I mean, first of all, you can't get an IPO done, right? Nobody.
My condolences, you just went public.
Yeah, I mean, it's not happening. So you're not going to go public. So, if you're a late stage growth investor, right? Suddenly you've got the paper that you put in and you thought you're going to flip it 6 months later at a 30-40% markup. Hey, that beats the broad market, and that's their comp. They're not investing like VCs. Their return threshold is not triple digits. They'll beat the market and be happy with it. But they invested with this idea of, hey, next stop IPO and a pop, and we begin to sell out. That's not available to them now. So they're reshifting and refocusing on what they do. And that's taken away that big slug of capital that was available and just sloshing around out there for all these companies. So, that's going to die down a little bit. But, to your point, yeah, I mean, as long as budget dollars, as long as CISOs have more money to spend, there are going to be more companies. Like that's a guarantee.
Well, and we're going to have to see whether or not any of those checks get written as we roll into RSA. So time will tell.
Yeah, I did have one point to make on that, though, real quickly. I know maybe we're bumping up against time, but again, looking back in at past cycles when we went through this, is keep in mind a lot of these budgets are set for the CISOs. They're set at the beginning of the year, right? And unless something materially changes, those are fairly set. So, I think what may be interesting to see is, and potentially when the chickens come home to roost, is in the beginning of 2023 when these budgets get reset and if they get set down a notch. But for right now, a lot of the budgets for this year I think have been allocated. So.
Well, we will have to see because we are in fact at time. I want to thank you both for a fascinating discussion, and we'll have to see how things shake out at RSA.
Terrific, Eric. It's great to be back here with you.
Yeah, it's a lot of fun. Thanks for having us, Eric. Happy to do it anytime. And thanks for everyone for tuning in.
And that is it for this episode of Next in Tech. Thanks to our audience for staying with us. And thanks to our production team, including Carolyn Wright, Katerina Yakoviello, Ethan Simon on the marketing events teams, and our studio lead, Kyle Canialosi. I hope that you'll join us for our next episode, where we're going to be kicking off June and Pride Month with an episode on diversity and inclusion. Hope you'll join us then, because there is always something next in tech.